And so I believe that, yes, the dollar will lose value. I'm less sure it will lose a lot of value against the euro. And near term, actually, I think that the dollar may even rally somewhat for the next 6 months or 3 months or so. But longer term, you can't be optimistic about the currency where you have a Fed chairman that says, well, if things go bad, we take extraordinary measures like dropping dollar bills from helicopters onto the U.S. They're not going to do that, never. But what they can do is electronically print money, as they do now. And I also want to point out, it is a big fallacy to believe that in weak economies you have deflation and in strong economies you have inflation. The opposite is true, because if my country is growing strongly, I can keep money tight and I can have budget surpluses, which are basically containing price increases across the board. But when the economy is weak, like in Latin America after 1981, when the petrodollar crisis happened, the response of government is to create fiscal deficits. In other words, they increase government spending. Most of it is usually wasted anyway. And at the same time, you have easy monetary policies. The two is a recipe for price increase somewhere in the system.
Well, certainly we have our own version of the petrodollar crisis today if what you're looking for is fiscal deficits and easy money policies. Those two things are married. I guess that is kind of at the heart of the attempt to understand timing in terms of a transition from deflation to inflation. You said earlier that it's not an either-or scenario, it's likely a both-and scenario, and perhaps in a certain sequence. Are there reference points that would be helpful to identifying deflation as deflation peters out, inflation, and as it accelerates to superinflation or hyperinflation? Maybe you could even give some definitions for what super and hyperinflation are, just to give some ideas to our listeners.
Well, let's put it this way. I think when you observe markets, you have to look for symptoms of developing trends. The market speaks usually. I mean, when someone says, well, there wasn't any inflation between, say, 2000 and 2008, then I tell them, well, look at the price of gold. Currencies worldwide have depreciated against the price of gold. So there has been a loss of purchasing power of paper currency. And I think what we will have to watch very closely is the position of the U.S. dollar. It's not that the weak U.S. dollar creates inflation. It's that inflation creates a weak dollar. And if you see the dollar weakening considerably, in particular, say, against precious metals or against relatively strong currencies like the Asian currencies, I think that would be a signal that some inflation is coming back into the system. On the other hand, if the dollar is strong as it was in 2008, all asset prices went down with the exception of U.S. government bonds and the U.S. dollar. In that case, I would say the threat of inflation is not very high, and that would more or less signal kind of a period of deflation. But as I said, you take, for instance, Mr. Bernanke. The S&P went up from 666 on March 6th to 956 just recently. Now it's easing. Let's say the S&P drops to around 800. What do you think the administration will do? A, they'll enact a second stimulus package, as Ms. Nora Tyson just said in Singapore, that may be necessary, and other people have expressed the same view, in particular Mr. Krugman. And at the same time, they'll monetize even more. Now, it may not help. So the S&P drops to around 700. Then they'll do the third stimulus package and even more. So all I'm saying is the more deflation we would have in the near term, the more likely it would be that we have very high inflation rates in the long run.
Once again, you're listening to the McAlvany Weekly Commentary at McAlvany.com. McAlvany.com.
I guess we're used to thinking in terms of high inflation rates, still in the 7, 8, 9, 10% range. What is the difference between inflation superinflation and hyperinflation, either put in monthly terms or annual terms, whichever you prefer?
Well, let's put it this way. An inflation rate of 7-8% per annum destroys a society in the long run. An inflation rate of, say, 20 to 50% per annum, the destruction occurs sooner. But both are bad. One is less bad than the other one, but both are bad. And all I can say is, normally, if you go up from an inflation rate such as we have now, and there are some debates as to what the inflation rate is, because as you pointed out earlier on, there's also some debate about the rate of unemployment in the United States. Some people have an unemployment rate of around 16%, and the government says it's, 9.5%. In my view, it's above 9.5%, and as you pointed out, the BLS makes wrong adjustments. The same way the BLS makes wrong adjustment for hedonic prices when they measure the consumer price index and so forth. So I think that inflation is still in the system, but not at a very high rate. But if you went up to, say, 6-7%, it would mean that real interest rates are negative, and then you would have to continue that policy. It would be very difficult to take the stimulus away. And so once you're at 7%, the likelihood that you go to 15% is very high. And once you're at 15%, the likelihood that you go up more is very high.
And that occurs because of the negative interest rate. They can't sell the bonds, so they just basically get forced into a corner and have to monetize everything. Is that what you're saying?
Yes, basically, yes. To a large extent, correct.
Monetization is a concept that I think most people don't really care about because they don't really understand it. And we've put it in terms of simply a bookkeeping entry, purchase of treasuries where money is fictitiously created out of nothing for the purchase of those treasuries. In the 1970s, we saw that as incredibly inflationary. How is it that, year to date, we've monetized close to $200 billion, and they have a mandate for over $1.2 trillion to monetize, and that's not translating into the kind of inflation we saw in the 70s?
Well, let's put it this way. In the 70s, we had a recession in 1970 and then a steeper recession in 74, but the economy thereafter recovered very strongly, and the debt to GDP level at that time was around 130%, and homeowners' equity was at the time 70%. In other words, the typical household had only borrowed 30% against the value of his house, and 70% was equity. Today, the household sector is in a different financial position. Homeowners' equity is only 43%, and considering that 33% of all homes in the U.S. are owned free of any mortgages, 67% are therefore have an equity of only 15% or less.